Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to the Better System Trader podcast. This is episode number 94. So we're inching closer and closer to that big 100th episode milestone, which is going to be huge, but more about that at a later date. Thanks for joining us today. Now, I'd just like to start off with a question. How many traders do you personally know that have cornered a market? If you're not familiar with the term corner the market, it means to get control of a commodity or a stock or some other type of asset in order to manipulate the price. There are a number of documented cases in history where people have tried to corner the market, and it usually doesn't work out too well for those who actually try. Now, I personally don't know any traders that have cornered a market. Well, actually, I didn't know any until I met this week's podcast guest, Kurt Sakaeda. Now, Kurt didn't actually set out to corner a market intentionally. It was more of an amusing accident. But this is just one of the entertaining stories that Kurt shares with us in our chat today. Now, if you've ever looked at the past winners of the World Cup Trading Championships, you would recognize Kurt's name because he's won it a few times. With his first win in 2000, so he's been trading for a while now. In our chat today, we discuss a mixture of trading topics, including how to incorporate seasonality into trading models, the dangers of counterparty risk and how to reduce them, finding profitable trades in a crisis, and, of course, how we accidentally cornered a futures market and the amusing results out of that. So let's jump to my chat with Kurt Sakaeda. Hi, Kurt. Thanks so much for joining us today. It's really great to have you here.
It's a pleasure to be here, Andrew.
So before we get started for today, can you share with us a little bit of your trading background, please?
Well, my trading background started just before I completed college. There was an airliner crash outside of Chicago. A brand new McDonnell Douglas DC-10 crashed on takeoff from O'Hare Airport. I got home, I saw it on the news, and I turned to my dad and I said, I'll bet you McDonnell Douglas recovers because the stock had taken a very sharp decline. And my dad said, well, you're 21 now, so you shouldn't be betting with me. You should be, if you want to make a bet, go to a brokerage firm. So the next day I took the last of my tuition money and I went over to a broker and bought McDonnell Douglas shares. The math to me, seemed fairly simple. The company traded for $28 a share. One quarter of it was Douglas Aviation that made airliners, and $21 of it was McDonnell Aviation, which was fighter bombers. So I figured I got McDonnell Aviation for a fair price, and I got Douglas Aviation for free. So a couple of weeks later, Langhorne Bond, Jimmy Carter's aviation administrator, went and certified the DC-10 for flight, and I sold out my McDonnell Douglas for a $7 profit. And was quite happy that I made myself $700 because I'd bought an even lot. And I thought I knew all there was to know about trading. Unfortunately, it took me 3 years to find another winning trade. So that's where I got started. After that, I got a job at a hedge fund, and my education increased much more quickly because one of the things the hedge fund had was a nice library where they had just piles of books about how options and futures, as well as material written by the owners about their strategies and what they were trying to do. So that led me to having two systems. One was I refer to it as the Time Magazine system, where I was looking for a catastrophe where I determined the market was seriously out of balance. And the second one was a smaller one that I'd realized when I'd seen the hedge fund traders working. And that was since they were selling volatility, if the underlying stock moved sharply, they would be in trouble because the the alarm lights would light up on their desk. And instead of doing what the model suggested, most of them would just go flat. So I knew that any street person was on an equal footing with a professional trader if there was a big move in the market, because at that point they were all abandoning their very carefully crafted computer models, and they were just going with their gut, and their gut said get out at all costs. Well, I can kind of understand that. If I'd blown my quarter's bonus in a couple of minutes, that would affect me greatly. Yeah. Now, mind you, I wasn't working on the floor. I was just a back office computer guy. So that was my second trading system, where I would sell volatility whenever there was a sharp move in the market. And later on, I went down to CBOE and would have drinks with friends after work. And somebody went and said, there's a seasonal pattern in markets. And I said, boy, you smug little SOB, I'm going to show you. I'm going to go to the CBOE data library and throw it on my computer, and I will prove there is no seasonality. At which point, a couple of weeks in, I've loaded the data in my spreadsheet, and I said, this thing's kind of shaky, but it would work. And I will say at that point, the discipline was very useful, because my first at bat, I said, well, the best day would be to sell would be in July, and then you would buy it back in November. But it's already August, so I'm going to wait another year, and then wait until the best day in July. Turned out that was actually quite lucky, because there was an El Nino that year, and had I completed the model a couple of weeks earlier, I would have been short in a rising market. Due to the El Nino, the crops burned up in the fields, and the price of grain didn't go down as we headed towards the harvest. It went up. So bit of luck there. And then as I went along, I perfected the model, and I increased the number of different items. My objective initially was to have one of everything, because that would be a crude form of diversification. Obviously there's a limit there, because if you're long gasoline and you're long crude oil, there's not much diversification there, because, they trade within their price motions are within like 2 or 3% of each other. There's people who trade the crack, but the margins are just so incredibly thin that it's not possible. And I'll say one of the great things about seasonality, if you can stomach the time frames and the big swings, it was one of the few systems that would overcome the $100 round trips that we got in the early 90s. I mean, today, I think there are accounts where people pay $1 a trade or something round trip, and I'm just flabbergasted, because I remember walking into the discount brokerage, and the guy tells me, "Oh yeah, these are really cheap. It only costs you $100 for a round trip." So anyway, so that was part of the design, was it had to overcome that level of commission. So time frames being what they were, it was just simply not possible for somebody out on the street to have a system that ran in time frames smaller than that, because as your time frame goes up, your profits go up proportionally, but so do the losses. So instantly you're tossed into just astounding numbers to people who aren't traders. You start talking about, oh yeah, it's doing okay. It's not performing terribly well, but it's only down $1,000. People who don't understand trading are just flabbergasted at the number and that you're putting up with this. And oh yeah, I cleared the soybeans trade, and it came off at $10,000 a contract, because over 6 months you're going to get a substantial move.
So that seasonality, is that a big part of your trading today?
Oh, that's actually pretty much the core of it right now.
Right.
I have other ideas that seem to be working. So we'll have to see how that goes. But right now, seasonality is the core of where the money comes from.
Yeah. Okay. And are you only using that in the futures markets, or are there other markets that you can apply this seasonality to?
Well, initially I just applied it to markets because I said, gee, obviously grain and grown products are going to be seasonal because you can only plant it at a certain part of the year, and you can only harvest it at a certain part of the year. But then I went to an investment conference. Mostly I went because it was in Las Vegas, but still made an attempt to go and show up. And there was a guy there selling a seasonal trading system for stocks. And while I was there, the light bulb went off, and I said, gee, seasonality, I can figure that out. And so I went home, and at the end of about 2 months, I had a seasonal system that just at nighttime, it would grind up my computer, and in the morning, there was a whole list of recommended trades to make. So stocks and commodities, yeah.
Okay, so can you give us a kind of an example on? I think it's kind of obvious how seasonality in futures works because it's based on seasons and crops and cycles like that. But how do you actually apply that to stocks? Like, can you give us an example of how you might apply that to stock positions?
Retail stocks, for example, hit their peak in early December.
Right.
Because what'll happen is that everybody will be looking to the Christmas season, since retailers basically they make their money in Q4 in that 30 days between Thanksgiving and Christmas. So they peak in early December because of all the anticipation of Christmas sales. Hershey's candy peaks on February 14th, which is Valentine's Day. Technology stocks, not all, but some technology stocks tend to decline as we head into tax day in the United States because the company hands out shares and options to the employees. And when the employees have to pay taxes, they don't pay. The government doesn't want shares and options; they want cash. So the high technology company has a little bit of a setback while the employees sell off enough shares and options to pay their taxes. So things like that. Let's see, cruise liners, I think they peak in January because the weather's horrible, at least in the northern hemisphere, and you want to go someplace nice in the middle of winter season. So everybody books a cruise liner in the middle of winter.
So I think a lot of those examples that you just gave there are kind of almost common sense, but how do you actually go about finding these tendencies to put in models?
Well, what I do is I go and download a complete history of the prices, at least as much as I can, because, a lot of the information is spotty, or a lot of companies merge and then they disappear and things like that. So I'll download the complete history of companies. Some are pretty consistent. I mean, like American Telephone and Telegraph and IBM go back a long time. And then I just lay the data. I average the data by business day, and I fill in the holes for things like holidays and New Year's and Christmas. So then I see if I have a wave pattern there, and then it's just pretty simple. You sell at the high and buy at the low. Now, there are a couple of filters I throw on for stocks, and it keeps the total number of disasters to a minimum. I won't go long stock because I am going to have to hold it for a really long time unless it's actually got underlying earnings and assets. So a lot of internet companies, I won't touch them on, even if the cycle looks good, because I know that they have no earnings and assets. So they could conceivably go under while I'm holding it. My only example there is Enron, which was not a seasonal play. It turned up on my old options trading system one day. Enron made a massive move down to the downside from $90 a share, I think, to like 85, 84, somewhere in that range. And so it triggered my options system, and I sold calls against it. I said, gee, I thought Enron was making money, but according to the latest S&P sheets, it's not making any money. So I sold calls. Not because it was a genius, but just because it just triggered the system. If I'd been really smart, I wrote it short all the way to zero. But in the same time frame that you're holding it short, from June until December, the company just disappeared off the face of the earth. So you don't want to, no matter how good the cycle looks, you don't want to hold a company without earnings and assets. If it's making money, it'll be around for the completion of the cycle. And then the reverse works for short stocks. The wave pattern might look good. This year's pattern might look like the perfect average. But if it's making a lot of money, I don't want to short it, because it could take off. This only failed twice. Well, part of it was I lost discipline, and I won't blame it on my broker. It's my fault because one of the things I pay a full service broker for is ideas. And I was holding Lehman Brothers and Bear Stearns in April of, I guess, 2008, which was their sell season, and I hadn't made any money. The stocks had stood still for 6 months, and so my broker came up with a suggestion. Gee, why don't you hold it for another year? Because not only will you make money, but you will also avoid taxes. Because if you hold stocks for 6 months and then turn them over, you're going to pay a fair level of taxes in the States anyway. So I said, gee, that sounds like a good idea. And from April of 2008, we go to September, October of 2008, where Bear Stearns and Lehman Brothers both went. Well, Bear Stearns, I think, went to $4 and Lehman went to zero. So it's not a perfect filter. Having a company that has assets and earnings is not a perfect filter, but it does save me a lot of trouble.
Yeah. Okay, so you just mentioned there that you use a full service broker to get to find some trading ideas. Are there any other kind of techniques you use to come up with ideas to try out?
The magazine cover, which is kind of evolving right now because the magazines are going away and everything's going to internet. But Time Magazine itself went and published a file where they go and show that every time companies on Time, if it's something bad, the company will be up in 6 months, and if it's something good, the company will be down in 6 months. The last one I can think of was when Mr. Jobs passed away, and Apple Computer was at a low, and then a couple of months later, it was up over $50 a share. It's basically you're kind of looking for a panic, and that's something that's another thing that I do. Let's see, what was the last one? It was Volkswagen. Volkswagen had the disaster with their computerized emission controls.
Yep.
And it's the world's largest car company. The total value of Volkswagen minus its diesel division is still really big, and much bigger than I believe it plummeted down to about from 38 to 24 or thereabouts. And even if you subtract out the diesel division and then subtract out what the Department of Justice was threatening to fine them with, it was still worth more than $24 a share. So, and it was yielding $4 a year in dividends. So, I could I could buy it and afford to wait. I did let go of it last January.
So when you see those kind of conditions where the markets are out of balance and you think that there's some good value there, how do you kind of integrate that into your seasonality models? Do you kind of merge the two somehow, or does one override the other, or what do you do in those type of situations?
Well, I couldn't find any seasonality with Volkswagen, so and I kind of hate those because the great thing about seasonality is not only does it give you an entry, it gives you an exit. The data on Volkswagen didn't imply that there was a seasonal cycle, so I kind of had to go and pull out the Edwards and McGee and start making charts on it. But in most cases, I'm really happy if I see a seasonal cycle and the price of the stock, or if there's a disaster in the grain market, if the wave lines up with the seasonal model. So, for example, this summer, if there's a drought and bean prices or a flood and bean prices had really high, and all the magazines and news coverage, you show some farmers standing out in the middle of a ruined field, that will usually go and work in your favor, and then head lower. So you would short that and pick up the grain cheaper in the fall. It's hard. It's a little bit hard to gauge on things like that, because I do remember one year where I got stopped out because I shorted a disaster and the price just kept going higher. So yeah, I'm much happier if I see a disaster and it lines up and it lines up with some seasonal trades, because then the seasonality gets you an exit. One problem that I think any good trader remembers is I bought this thing and I made $10,000 a contract, and then I closed it at a loser because I didn't have an exit technique. Mm. So seasonality gives me a nice exit technique where I can just let time and the general weight of the world push in my favor.
So when you're looking at these seasonality tendencies or seasonal tendencies, and you're perhaps you're seeing that one particular date in the year is a strong day and then one's a weekday, how do you know when you're testing those ideas? How do you know that you're not actually just curve fitting data and that could just be a random coincidence or something like that? Is that something that you consider or?
Well, that's something that I do consider. I mean, one of my concerns is that I'm curve fitting and that I just guess right all the time. But and that's possible. I mean, I have played a poker tournament where I was down to one chip and I came back and took first prize. But it's like a little tournament at a little corner casino or something. So it is possible to just win several times in a row when you really shouldn't. I accept that as a possibility. But in the case of seasonality, we don't have to worry about curve fitting too much because we have causation. If you're just looking at some wave and you say, well, when this wave occurs, then the underlying mechanism or the underlying prices are going to go like this. Well, that's a little trickier because you're not actually stating what causation is. Here I'm stating that the reason grain is high in summer is because there probably isn't much of it around. And then the reason grain is cheap in the fall is there's lots of it. So we have a causation established. So you're not just blindly betting on something.
Yeah. Okay. Now, I just want to switch gears now into risk control. But before we do that, I just want to ask you about the World Cup trading, because you've achieved some pretty incredible results over the years, 600%, nearly 1,000%. Now, I know that the position sizing and things like that you use in the World Cup is not really, doesn't replicate in real life because you're trying to hit it out of the park. But perhaps can you just tell us a little bit about your approach in the World Cup and the things that you were doing there to get those incredible results?
Well, pretty much the World Cup results are based on my decision is based to take a trade or not. It's based on whether or not the margin clerk has been yelling at me. So if the margin clerk says I have plenty of money, I'll take the trade. And if he's yelling at me, I won't. That's basically how that works. It's a highly risky It's highly risky because, it's like driving a race car. Certainly you wouldn't go to work at 200 miles an hour and you wouldn't take the curve without slowing down, just downshifting a little bit and maybe dropping down to 190. So for working conditions, as an analog, you would, just drive nice and quiet and just get to work and do what you have to do and get back. So that's kind of how I see the World Cup. And pretty much everybody I've talked to who's picked up a trophy has said that they were kind of doing the same thing. So it is an isolated account by itself. And it's so if you blow that up, that's it. You just go and call it an end, and then hope for a trophy next year. Although one or two guys are really stubborn, and they'll just keep throwing another 10,000 down and going with extraordinarily risky strategies.
Mm. So were you using seasonality in the World Cup as well?
Oh, yes. All of them were all seasonal trades. I have, like I said, experimental things, and I've got the Time Magazine and options thing, but seasonality basically drives my World Cup accounts. It's hard to have a model where you can have something where you can make a trade like that, because most of the thing with Time Magazine is companies. Some company will make a mistake, or they'll be kind of overblown where everybody likes them, and it's kind of the kiss of death, because if everybody likes you, then it means you're at your peak, and you'll head south. You'll head south eventually. The other issue is time frames, in that if I take a stock or some other position due to a disaster, like I said, if it's counter seasonal, I just absolutely hate it, because I've got to set the computer to draw graphs all night, and then when I wake up, I flip through the graphs and stand on my head and look at them from every possible angle until I see an exit, and it's a bit more work. So yeah, with the Robbins World Cup accounts, it's margined up to the hilt, and if things go well, then you make money. You make astounding amounts of money relative to the amount you put in. But I wouldn't trade that way all the time.
No. Okay, so let's move on to risks, because you've kind of touched on a few already in our chat so far. But what do you think are some of the risks that we really need to be mindful of today as traders?
Well, two things that strike me are counterparty risk, because I think that right now some of the banks are a bit shaky, and they're hiding behind banking regulation. So I have been burned a couple of times with this. I got burned at Man Financial and then at Peregrine. And a little bit of human intelligence would have saved me a great deal of difficulty, but I didn't put all the puzzle pieces together. At Man Financial, I was talking to my broker every day, because we phone in orders, and he was complaining that human resources would come and waste half his day twisting his arm trying to get him to sign his paycheck, his bonuses and commissions over to them, and he would get shares of Man Financial in exchange. And it didn't occur to me, gee, if they're trying to cheat the brokers, what are they doing to the clients? And then again at Peregrine, and I didn't hear about this until after the fact, but the For Peregrine, I was going through an introducing broker, and the introducing broker, it turned out, had been complaining left and right about the fact that Peregrine was in arrears with his commissions and bonuses, and money he was due. Had I gone over there and bought him a beer, I might have known that. So counterparties are a risk, I think, which is just something we have to be mindful of. There haven't been any major collapses where people have been burned, except for Peregrine and Man Financial. So everybody kind of blindly throws all their money into the one bank that's most convenient. This may not be a good strategy.
So how did? Oh, sorry. I was just going to say. So how do you? So you kind of you had a connection with your brokers then. So these days a lot of people are just electronic brokers, and they don't get that kind of insights into what's happening behind the scenes. So how can we manage counterparty risks like that without having all the information?
Well, the counterparty risk can be controlled two ways. Number one, we do have better intelligence today, because instead of having to run to the library and look at 6-month-old S&P sheets, you can go onto the internet and Google your counterparty, and a lot of them are publicly traded. And this brings me to my favorite story about risk control, which is supposedly a very famous trader was looking at Man Financial's graph, and she went and said, boy, that looks like that would crash down below zero if it wasn't for the fact it was a stock. and the light bulb went off in her head, and she immediately closed her account. Just I think within months before Man Financial's failure. So if you're trading a public company, or rather, if you're trading with a public company, say the people holding your money are somebody, I don't know, let's say a Bank America or Citibank or something like that, you can just Google them and look at what Google and Yahoo have for them, and that'll give, as well as for the chartists out there, you can go and pull up the chart and say, gee, my money's in this bank and it's heading, and the chart looks terrible. It looks like it's going to break down and head towards zero. It might be a clue. I couldn't tell you for sure because, like I said, I'm not much of a chartist. I hate using charts because I always go back over it a few days later and say, oh, that wasn't right. I should have looked at this thing here.
So what about diversification then across brokers and banks? How can we better manage that?
In my case, I diversify by objective. I have plans to maybe someday buy a house or a beachfront condominium, and I have money set aside there, and I have money set aside to buy a new car in case I walk out of my house and the car's on fire or something. And so I have my accounts are somewhat diversified because it's across about 5 or 6 different banks and brokerages. I have a story there. I'll tell you about me and Ed and Bob, and we're traders, and we go and meet every once in a while and have lunch. And one day I sat down with them, and Bob asked me about how did you two fare at Man Financial? Because the reason I'd met Ed was that he was at Man Financial too when it blew up, and we got to talking about what we went through. And so I told Bob that damage wasn't too bad for me because I had money spread across, half a dozen different banks and brokers. And Ed, things were pretty rough for him because he had all his money at Man Financial. And so until things got cleared up, he had to borrow money from his parents to pay his rent. So Ed says, well, what would you do if you had all your money in one place? And I said, well, I'd probably put it into 3 different banks or brokerages so that you'd be okay if you lost one. Anyway, the next month, Peregrine Financial went under, and we met for lunch again. And so the topic of discussion was how bad was the damage. In my case, not too much. I had 2 small accounts there, which were basically workbench accounts, and I was just tinkering around with them. And so I lost those, and they worked out to about, I think, $50,000 or $60,000, but it wasn't the bulk of my capital. It is a lot of money, but relatively speaking, it wasn't a whole lot. Ed lost everything because he had everything at Peregrine, and then Bob was really mad, and I said, Bob, what are you mad about? And he says, you did this to me. And I said, what did I do? And he said, you told me to divide my money into 3 parts, and I lost 33%. If you had said divide your money into 4 parts, I'd have only lost 25%. So the point there is that you can't wait on diversification and defensive measures because you can't tell when these things are going to happen. I like the Bible phrase is like a thief in the night, right? There's no expectation, but it just happened.
Yeah, so that's an interesting story, Kurt. Now, another one that we were chatting before this recording, and you mentioned a story about cornering the market. I thought was quite amusing. Do you want to share that one as well while we're talking about stories?
Oh, yes, certainly. That was early on, and I really didn't have all that much money, but I was trading thin contracts. I think lumber 6 or 7 months out. And so the model went and said, I don't remember if it was buy or sell, but it said, take a position in lumber. And then the next morning I would pick up the sheet and it would say, you should pick up more lumber. And so I increased the size to 2 contracts. And then eventually I got to 5. And when I got to 5, the day after, I got phone calls from compliance departments from all the parties involved, the introducing broker, the broker, and some regulatory people. And they said, you've cornered the market. And I said, what are you talking about? Well, I owned 5 of 8 of the open contracts. So that's 62.5%. Technically, that's cornering the market. I wish I'd saved all the paperwork, because that would, someday people are somebody's going to say, well, you cornered the market way back when. And I would love to be able to pull up all the paperwork and say, yeah, I owned 5 of 8.
That's funny. Okay, I might just start wrapping up, but first I just want to ask you a little bit about longevity, because you've obviously been trading over quite a few years now. So what do you think is, actually, firstly, how has your trading kind of changed over the years?
Well, over the years, I've basically, when I started, I was betting everything there was, because, like I said, with the McDonnell Douglas deal, it was all the money I had. And as I got a little bit more money, and also I got older and closer to retirement, I would start figuring out how big a bite I would take. Initially, a lot of my experiments were one lot or one contract, and then gradually work them up. I have an acquaintance who is fearless. He'll pick up a brand new system, and the system will say trade 10. And all of a sudden, he'll be down $6,000 a lot, and for $60,000, and it's just like astounding to me. So, I would say it has to do with my just scaling into trades. If I have a new idea for a trade, I'll do 1 or 2 lots and see if I can make any money with that. And then if it comes up again, I'll go from 1 lot to 2 lots, and then if it comes up a third time, I'll try and work 3 lots. The other thing that I did do for mathematical risk control was I sat down and I programmed 8 computers to go and work out the what's known as the correlation coefficient between all commodities contracts. So using correlation coefficient, if you're long something which works in opposition to something else, you can you're a bit safer, because there, as well as it also accounts for short and long. So if you're long gasoline and short crude oil, for a simple example, they're negatively correlated at 0.95 or higher, in which case you can take on a very large position with long crude oil and short gasoline. So I would have to say, despite my foibles into risk control, or maybe it was because of my foibles and mistakes, that I developed all the risk control rules. But yeah, the other thing was, like I said, I don't have any necessity to go and I don't feel any necessity to go and make a trade where at scale until I understand it and how it handles. A certain amount of, I think the description I've heard is the right kind of brave. So brave enough to try something new, not super brave where I try it with a 50 lot.
All right, awesome. Thank you very much, Kurt. So I might just start wrapping up now with a few quick closing questions. The first one, what's the biggest lesson you've learnt through trading?
Get it executed and do the work. I would have to say those are the two. The weakness, two of the weaknesses I see with traders who have trouble is they're not doing the work, or they're not executing. They spend too much time in an analysis paralysis where they're saying, "Oh, there's just one more thing I can try." And basically, once I have a functional model, I'll have my one lots moving, and I'll see how it handles. But I also do beat the data to death before I actually go and make a move. Oh, in the case of a disaster, I've downloaded all the web pages, I've printed them out, I've marked them up, I've gone and put them into a spreadsheet, and I say, okay, this is what I think of the company. So yeah, work and execution.
So when you say traders not doing the work, you mean they're not they're taking shortcuts, or they're not dedicated enough to put in the hard yards? Is that what you mean?
Putting in the work, for example, if you go in the case of seasonal trading, I have tried to sell and give away the notes, and it doesn't work, because what happens is the guy has not actually gone and calculated out and ground out all the numbers and searched for errors. I'm fairly confident in my numbers because I've put them all together and ground them down and sprinkled them all over each other, and I have a solution. If you don't actually do that work, you don't have faith in the research.
Yeah.
So I find a lot of people who buy systems from other people, they'll put on some trades and they'll say, "Oh, this doesn't work," and give up, or they'll get too nervous because they haven't done the work. They've made the system says, well, on average you should look for $1,000 win, and they get nervous at $500 and they say, okay, I'm out, and they don't get to realize exactly because they get scared. They say, well, $500 is a lot of money, so need to go and take it. So if you've done the research, you can sit around and just watch the prices go up and down, and it doesn't bother you because you know that the weight of the universe works in your favor.
Yeah, that's a great point. Thanks for sharing that, Kurt. Next question: what is the best trading advice you've ever received?
Best trading advice was pretty much the same thing. It was from Mr. Mark Cook, who is a farmer in Ohio, who is a great grain trader, and he said his motto was, "Everybody in the world can outsmart me, but I will not be outworked." You have, again, preparation. So Mark Cook really understood grain because he produces a lot of it, and he understood the costs involved and things like that. And also he could go and do up close testing of the local area. For example, if he goes over the grain elevators and they're all empty or they're all full, he probably can use that information to go and adjust his model for what he thinks grain is going to do. So that was the best advice.
Okay, cool. And what about, do you have any favorite trading books?
Favorite trading books? I started with Seasonal Trading by, I think, either Bernstein or Williams. I can't recall now, and unfortunately, all my books have been sent away. But that would be the first one. I enjoyed More Money Than God. I think that was Sebastian Mallaby. He explained about the rise of the American hedge fund.
Okay. All right. Thanks, Kurt. What's the best way for listeners to get in touch with you?
You can send me an email at kurt@bl-3.com.
Okay, cool. All right. Well, thank you very much for your time today, Kurt. It's been really great chatting to you. Now, is there anything else that you'd like to mention before we wrap up?
Oh, can't think of anything. I appreciate the opportunity to talk with you. Hope we can do it again in the future.
Yeah, it's been really enjoyable. So thank you very much for spending time with us today, Kurt. Really do appreciate it, and sharing your insights. And that was awesome. So thanks again, and I wish you all the best.
Thank you.
All right, cheers.
Cheers.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.